So now we're going to go over some more factors that affect the price of an option. There are a variety of different factors that affect them, and implied volatility is one of the biggest factors. So the implied volatility of an option is influenced by the supply and demand of the underlying options and by the market expectations of the stock price direction, right? So when there's higher demand, there's higher IV, and when there's lower demand, there's lower IV. And typically, for a season like earnings season, which is happening this week, for example, we will see IVs increase across the board. Why? Because there's increased speculation, more people that are willing to bet on every single strike and expiry because people are anxious about how the stock is going to perform. So maybe you think Apple's going to go up, somebody else thinks Apple's going to go down, and therefore they bet on all the different strikes and expiries, and that causes the entire options chain to increase in price across the board. That goes to the previous video where I was showing you the option chain, and you see the IV on the side there. It causes a increase in that IV across the board majority of the time. So how do you tell when something's expensive and something is not that expensive, right? Remember that the IV is the open interest plus volume as a factor, okay? Like open interest and volume are a combining factor that plays a part into IV percentage. So whenever we see IVs are 30% to 50%, and by the way, I've obviously come up with this guideline for you guys to simplify things because, many years I went about just like you, not knowing that things were expensive or things were cheap, and finally I got fed up and I started to analyze things very deeply to understand that, okay, when things reach these levels, they're okay to trade, and when things reach higher levels, they're not okay to trade. So I've simplified it back for you into this easy guide to know when things are fairly priced and overpriced. When it's 30 or 50%, options are typically fairly priced. Okay, not so crowded. That means you can still buy these at a decent price, and they have the capability to expand in value, right? If it's low IV, means not so many people are in the trade just yet, not for that strike and expiry, right? This also allows other people to jump into the trade, right? Then if it's 51 to 80%, so this becomes moderately overpriced, okay? That means it's slightly crowded now. That means now there are more people taking these contracts, and the IVs are starting to get higher now. This is the mid-level, okay? You can still buy contracts that are between 51 to 80% IV if you are trading in the short term, okay? But don't buy those contracts for the long term because they will have more to collapse. As I mentioned before, things with the higher volatility will have more to lose, right? Then lastly, if something is 81% plus, right, just ignore it. These are overpriced and overcrowded. Avoid these at all costs. You will realize that one of the biggest mistakes that you would ever make that you're not even realizing is buying option contracts that are 100% plus IV, okay? And these are typically trades that are everybody's like, oh my God, look, this stock is moving and da-da-da. And like maybe, for example, last week when Tesla was trading, right, after earnings, it was trading at almost 150 to 200% IV. And everybody was still buying contracts. And then you would realize that what will happen is everybody will dump those contracts at some point in time. Why? Or the IV will get collapsed. Why? Because people will start to dump the underlying stock. They will dump Tesla shares. And when Tesla shares price go down, then there goes your IV along with it because everybody will rush to the exits at the same time. Okay? That's what we call an IV crush. We're going to talk about that next. So use these as a guideline as how to choose the right quality options contracts. This together with the Greeks, right? Those are very, very important things, okay? I bet you have not been paying attention to these, but you should pay attention to this before you take a trade, okay? Not to mention there's also something called open interest and volume, right? As I mentioned. What is open interest? This is the number of people holding contracts for that specific strike and expiry. The number of open contracts. If you're an option seller and you sell contracts, it adds to open interest, so open interest will go up. If you buy those contracts back, you're taking them out of circulation, open interest will decrease, okay? And volume is just the total number of contracts traded hands during the whole day, okay? So open interest changes only once a day at the market open. You will realize before market open, you'll be able to see it, and it will change once a day, okay? Volume will change throughout the whole day. So you typically will not see open interest change throughout the day. At least you don't see it on TOS. You will only see the volume change. So the open interest plus the volume will typically either increase or decrease. So if you see open interest plus the volume, if the resulting next day open interest is higher, this means more people are holding the contract, okay? If open interest plus volume gives you a certain number, and then the number tomorrow is lower, that means people have closed those contracts out, okay? So that's how you can also know if there's conviction in the stock, if people are still committing to the trade idea, right? And this will all play into a later module that I will upload in the future, which is studying unusual options activity. This is a module that I will add to this course in the next couple of months, okay? So what are IV crushes, okay? And this is when your IV depresses all of a sudden, right? Very, very suddenly. So you can lose money on an options contract even when you correctly guess the direction of the underlying security's performance. IV crush is usually the culprit here, okay? So for example, in earnings reports, you have one, and this is probably the most common occurrence of IV crush. It's when people are playing earnings news. They buy into a options contract that has a high IV, like 100% plus, and then the stock after hours goes in the money, okay? It goes in the money. And what happens is that when the market opens, you find that the options contract premium is completely wrecked instead of gaining value. Why does that happen? Right? The stock went in the money. So that means you should be making money on that, right? But when the market opens, suddenly you realize my contract's not even profitable. Well, the first thing is those contracts are usually weekly expiries and sometimes could be expiring on Thursday or Friday. This is when contracts are the most susceptible to time decay and are the highest volatility. Remember, the shorter the expiry gets, the higher the volatility, right? And when volatility is increased, it's going to create a lot of erratic price action. The second thing is everybody's taking profits at the same time at the market open. So algos are really fast. They're not going to wait for you to click your button and all of that. They're just automatically send all the orders through and it's going to go really quickly, right? So when that happens, it immediately depresses the IV, and that's why your contracts go from, even though being in the money, they go to becoming non-profitable, okay? So that's the reason why you avoid 100% plus IV contracts to begin with, because they're susceptible to crushes, right? Then you also have market volatility. Another scenario is where the market is extremely volatile and the prices and everything start to rise in anticipation of a news event or something. Right now, right? For example, last Friday, market rallied like crazy, right? So then everybody starts to purchase puts and calls, and you realize that sometime in the last week, when you were buying puts and calls, they weren't really gaining that much value, right? Like what's going on, right? So like imagine you had the S&P 500. Let's look at some stocks that really ran crazy, right? Like for example, Tesla, right? If you were to buy a call option up here, right, you would realize, wait a minute, why is the price of the call option not really going up that much, right? When the stock has ran so much, right? Even if you bought a relatively close strike, like let's say maybe 178 or 180, right? Strike. And maybe it's for this week expiry. You bought it on Friday and you bought it while Tesla was rallying, right? And you realize like, wait a minute, the price is not going up. I bet you guys have been through these scenarios where you buy an options contract and you see the IVs are not, the price of the premiums are not really moving, right? Why does this happen? Well, it happens because there are too many people in the trade. The implied volatility of that chain is too high, causing everybody to be holding contracts and not enough expansion of IV, right? So if there is not many people who want to get in and a lot of people holding the contracts, there's too much demand and no supply, then prices cannot rise of those contracts, right? So that's the culprit. And then when Tesla moves just slightly down, everybody throws the contracts away and then your IV gets crushed again. So that's scenario number 2, right? Then you have scenario number 3, which is volatility versus the expected move. And this is when volatility is high and the expected move of the underlying is high, which means the investment is riskier. So when speculation is high, the IV tends to shoot up. But once the information has been revealed, the uncertainty about the price is high, and that causes a crush in the premiums. This could be any news event. For example, this week we have FOMC, right? Maybe people are betting on a certain outcome. And so in this kind of a scenario, the speculation is very high. And when speculation is very high, that means everybody's going to buy different strikes, different expiries. Oh, let's all go. Let's buy everything, right? And then once the news is revealed, whatever the news is revealed in the market, then volatility is at its highest, right? But the certainty about the price is also high now, right? Because the news is broken. So now everybody knows what the outcome is. And when everybody knows what the outcome is at the same time, that causes everyone to rush to the door at the same time as well. That causes the crush, okay? So you have to know these things. These are like bread butter. You know what? These like take like 2-3 years of trading to figure out if you were just figuring it out on your own. But hey, you decided to take the EGA course, and this is what we help you with. We help you get there sooner so that you don't make these mistakes over and over again, and then you figure it out. Now you're taking the course, you know these things are about to happen, you can avoid it. You see 180+% IV, just ignore the trade and move on. Find another trade. There are so many other things to trade in a day. There are thousands of opportunities. You just need to pick the right one. Okay? So that's IV crush explained. Now, what about short or gamma squeezes? What are those? Right? You have heard the term short squeeze or gamma squeeze. What is that? They're similar but not the same. A gamma squeeze is a more violent version of a short squeeze. But what's a short squeeze? Right? So let's talk about what a gamma squeeze is, and you'll understand what a short squeeze is from there, right? Or actually, let me explain what a short squeeze is, then you'll understand what a gamma squeeze is. So imagine that everybody in the market is bearish on a stock, right? I don't know if this is ringing any bells, but if it hasn't rung any bells yet, look at this chart here, right? And you can see that this was GameStop, the stock that became a meme stock in 2021. You guys remember the GameStop saga that happened? What happened with GameStop? It was a company that was super shorted, okay? Everybody was short on it. That means there were a lot of people that expected the company to go bust, okay? And then a group of people's speculation about the stock started to rise, okay? And they started to make assumptions about it, saying that, oh, you know what? I think the stock can turn around. This groupthink mentality started to envelope a online platform or forum called Wall Street Bets. And everybody started to go and buy the stock, okay? Now, what happens when you are short a stock? Remember, you have borrowed the stock from somebody else. Remember the price action mechanism that I taught you from module 1, right? A short is when you are borrowing from somebody, and then the broker helps you to borrow from somebody, and then when the price goes down, you're gonna give that stock back, right? Now, in this case, in GameStop's case, there were a whole bunch of people who were short, and then a whole other people who were buying shares long, okay? So this caused the price to go up, right? This caused the price to go up initially. And so the shorts who are holding this, expecting the price to go down, are hurting, right? They're in losses. And guess what? Every time they let go of the position, or they try to sell the position, that position was being put into the market and somebody else was grabbing it and buying it to go even higher, okay? So when a short is closed out, remember what happens? It's the opposite of a long. So when you close out a short position, it's actually going to make the price go up. So if shorts close out at the same time while everybody is overly buying something, it's going to cause something called a squeeze, okay? That's what a short squeeze is, because the shorts are trying to get out and people are trying to buy. So every share that becomes available gets bought up and adds to this vicious cycle of the price going higher and higher and higher and higher and higher. Okay? That's where a couple of hedge funds went broke and lost billions of dollars, right? So now, GameStop was not just a short squeeze. It was also a gamma squeeze. So what is a gamma squeeze now? A gamma squeeze is very like a short squeeze, okay? So it starts with investors making certain assumptions about a particular stock, for example, GameStop, right? When a lot of traders think that the prices are going to rise in the short term, they purchase a lot of short-dated call options, right? So they purchase call options, right? Now, when the call options are bought, you have to remember something. The broker has to hedge that risk. Okay? They have to hedge the risk. I've spoken to you about this before. So, in order to hedge the risk, right, they have to increase their positions in the stock to offset the risk. Because what the broker will do is, if you buy a call, they will buy a put against you. Okay? And when they buy a put against you, they become hedged. So what they have to do is they have to go into the market and they have to buy shares to cover the put. Okay? So that their exposure is balanced. So this causes a cascading effect of prices rising in the stock because they have to buy shares to cover their position and the hedge, right? And then this causes more buying in the stock as more people pile into the call options. So the more buying of the stock causes the call options to go further up in price, and that causes more stock buying, and that causes more call options to be bought. And you can see where I'm going with this. It causes a squeeze in price action. And you have to remember that brokers have to generally keep a delta neutral position, and thus this imbalance of delta creates gamma chaos. Hence the name gamma squeeze. Okay? Because they are constantly trying to balance the delta. So remember that how market makers or market dealers, they view the market. They don't view it as though, oh, you know, Jeffrey took one option, I'm going to buy against Jeffrey. You know, somebody else, I don't know, some other person with a different name. Oh, this person took this option, I'm going to do it this way. No, they don't. They look at the total market exposure. And everything is measured in terms of delta. Okay, delta. The Greek, delta, right? So how much of delta exposure does the market maker have? They'll look at that. And they will basically cover their exposure and try to go risk neutral because the market maker does not want to take on exposure. Not your exposure at least, or the market exposure. They have to try to be as delta neutral as possible until and unless they become biased. And if they want prices to swing in a certain direction where there is liquidity, they will push prices in that direction to grab that liquidity. Okay? So I know it might sound a little complicated, but I think it's pretty simple to understand, right? So that's your gamma squeeze explained, all right? So how do we take advantage of high IVs? Surely there must be a silver lining in all of this, right? Well, if you're a passive owner of stocks and you invest in tranches of 100 at a time, for example, 100 shares at a time, then high IVs can be a really good friend of yours. In fact, for me personally, every month, it's a really good income for me, right? Why? Because you can use something called a covered call strategy to temporarily rent your 100 shares as collateral to receive options premium in the short term outside of the implied move of the underlying stock, right? So, for example, I have 100 shares of Baba, okay? So I recently just played this covered call. So let's say I have 100 shares of Baba, okay? And I know that Baba has been on a very big rally for the past couple of weeks, because of the bullishness on China, right? So I know that it's entering the supply zone, right? We've learned all of this already, right? It's entering the supply zone, and there is a chance that we get reversed here, right? There is a chance. So what will I do? I will go ahead and sell some call options at a strike price that is unlikely to be tested by the market. How will I do this? Well, the first thing I will do is I have to establish where supply and demand is, right? And I've already established that, right? Find the key pivot points of the underlying. Then make sure that the ER doesn't clash, right? Because why? ERs will cause the market to speculate. So it can cause abrupt movements in the stock. And we don't want to get ourselves into an IV crush, right? Even though IV crush would be beneficial for us, we also risk the contract being in the money, which can cause a lot more problems than we want, okay? So we don't want to deal with being assigned. We just want to collect premium, right? So what we will do is we'll find a liquid 2 to 3 week out option for peak theta decay, right? Remember the curve I showed you on theta. Where was the peak decay? The peak decay was in the last week, right? Look, the last week. You remember this. The last week here is the peak theta decay, right? So we'll find a 2 to 3 week out option that will give us that peak theta decay. And an easy way to usually find it is strike any strike with 0.2 delta or the closest to it. So this is roughly a 20% chance of the options contract going in the money. That's what we want, right? We don't want the contract to go in the money at all. We just want to take a small piece of the pie, which is a dividend for holding the 100 shares, and make that in 2 to 3 weeks, and we're happy with that, right? And we want to do this when everybody's buying call options, right? So that was last week, which is when I've been selling covered calls for about 2 weeks now, right? So then you place a limit order closer to the ask price, and then you hopefully get filled, and that's how you set up your covered call strategy, okay? So what this will do is, let's say you own 100 shares of BABA. So for example, I own 1,400 shares of BABA, okay? So I can sell how many contracts? 14 contracts, because 14 divided by 100 is 14, right? 1,400 divided by 1,400 divided by 100 is 14, because there's 14 contracts that will make up 1,400 shares. So I can sell against those as collateral. And each contract, I think, paid me about $1.26, okay? So in just a 2-week period, this was roughly about 2,000, roughly. I think less than 2,000. It was 1,000 something maybe, okay? I think 1,700 or so. So roughly 1.7 to 2,000 just for 2 weeks, because I have shares and I'm selling calls to people who are overly exuberant, and they think BABA's going to keep going up, and I don't think so. So sometimes being on the sell side and taking advantage of high IVs can be beautiful, right? So I'm showing you both sides of the equation. There are some disadvantages of high IV, and there are advantages of high IV. You can play it both. You just need to know how to do it, okay? So that's how you're going to take advantage of that, right? So now, the last part of this module, we're going to go through extrinsic and intrinsic values. Now, extrinsic and intrinsic values are what gives your options pricing or value, right? So what is the extrinsic value? Extrinsic value is the potential value in the option, okay? This is usually linked to time value and volatility, right? The intrinsic value, or the true value, remember we have done intrinsic valuation in the second module, right? Where did this come from? The actual value. It comes from the spot price of the underlying. It comes from the exercise price and how far away you are from the strike price. It comes from the cash flow of the underlying, right? If there's dividends, etc., from the stock. And it comes from the risk-free rate, which is the bond pricing, right? Which we spoke about, interest rates, remember? So when an options contract is far away from expiry, it has both intrinsic and extrinsic value, okay? It has both of these when it's far away. As it gets closer towards the expiry, the extrinsic or potential value, the time value and the volatility, it erodes away, goes away. That's the reason why an option becomes very volatile close to expiry. It's because the time value of the money and the volatility erode away, right? It only leaves behind the intrinsic value of the option, the true value of the option, which boils down to the price of the underlying, the exercisable, the strike price, the cash flow, and the interest rate associated with it, right? Intrinsic value is affected by the time to maturity, expiry of the option, and the volatility of the underlying. Extrinsic value is affected by the potential of the option's time value and volatility. Okay? There's really not much to get complicated here except for to understand that when an option has time value, it has some potential, and that potential gradually falls away towards the expiry. At the expiry, it's about what the strike price is, where the underlying stock is in relation to the strike price, and that's all that matters. Is this options contract exercisable for shares? If it is, it has value. If it does not, then it does not have that much value. Okay? And that's why contracts will expire worthless. All right. And that's all you need to know in this module. So I'm going to see you guys in the next module here, and we're going to discuss how to choose contracts when you're making trades. So I'll see you soon.